we'll go ahead and get started. Heather, you got us recording already?
Yes.
Perfect. So this is a live Q&A about real estate and business. I've got a little over 20 years experience in this, and through everything I've done, there's one thing I continue to find myself as being very passionate about. And my passion is always helping other people. I go to a lot of these real estate conferences. I go to a lot of meetups and stuff like that. And I've met a lot of you people in real estate meetups and conferences. And during that time, it's always a blast. It's always, yes, there's great speakers inside the room. There's always fun people that are talking that you can learn. But I've always had so much fun being out in the hallway, talking to all of you guys, and there's great conversations, and there's good Q&A, there's good interaction. And that's kind of what I wanted this to be, was to, we don't always get to go to these conferences all the time. I know I have a very busy schedule, same as you all do. And, we go to these conferences, few and far between, we don't get to connect. So I wanted to try to do a Zoom and kind of do the same style thing, like out in the hallway, networking, ask some questions and get some feedback. Now, I'm not a person that likes talking about myself, and I always struggle with that. I even had a really hard time with posting my bio online and even posting it to Facebook. But everybody always asks me to do it because it's relevant experience from what I've done, where I've come from. So, I don't usually tell people about me. I usually ask them, and then they just start asking me a bunch of questions. And I thought, well, maybe that's what we should do. So to stop eating up our time, what I want you guys to do is, if you got questions about real estate, if you got questions about business, I want to first marry those two together. And I say real estate and business together a lot because I'll be completely honest. We own and operate multifamily apartment buildings around the United States. And by doing so, what we've learned is it's a business. We might own a 400 unit apartment building in a different city or a different state, but we own a $60 million business. It's an asset. Yes, it has tenants. But what we've learned is it's running a business. The value that you create with your tenants, your customers, your vendors, and then your relationship in the general public, like Google views and Google responses to negative comments, really helps you with your business reputation. And that's important because you have to think about that, is when a new tenant comes to your building, they want to know the representation of your business. How well do you run it? So I'll open it up for questions. Go for it. I'll answer them to the best of my ability.
What order do we want to go in today?
Let it eat.
Because I got one for you. And first, I got to jet out of here about 3:30. So when I leave, it's me. It's not you.
Okay.
I want to throw that out there.
Warning.
Yeah, just for the warning. But here's my question. Your buy box and focus, Eddie, is very narrow, and which I would expect after having been in the business 20 years. Mine's not nearly that narrow yet, but I'm working on it. Mm-hmm. But I've been all over reading Lindahl's book lately on market cycles and market conditions and that. And it strikes me that with a buy box that narrow, your market indicators must also be very narrow. So that's my question, is what things do you look for when you're looking at new markets or evaluating new markets to move into?
Well, I'm going to be completely honest. We get sent a lot of deals. I'm going to segue off your question for 1 second, but I'm going to bring it right back into focus. We get asked to do a lot of deals, partner on deals in other areas. We're very slow when it comes to making a decision on that because we're not the expert on that market. So we have to gain a lot of performance indicators, KPIs, when it comes to a new MSA to really know that we know the knowns on that investment. Because when it comes down to it, you really have to kind of be the expert of that area. You really have to know how the market's growing. And sometimes it's very hard to get that in a very short window. And let's be honest, there's a lot of risk in managing other people's money. You are using other people's money to buy these assets. So it's your fiduciary responsibility to make sure that you are doing the most educated risk factors when it comes to buying properties, especially outside your area of expertise. Now, mostly we buy predominantly in DFW, in the North Dallas market. Why is that? My asset manager is close to there. I'm close to here currently. We run construction right here in this backyard. We know our vendors. We know everything to know about this area. Yes, we own properties in South Carolina and in other markets in Texas, but we found when we really know an MSA extremely well, all the way down to the micro analysis of a demographic in a property, you can really hone in on how things are going to operate. So to answer your question, I think one of the biggest things that we think about when we see operators start buying in all different markets, how good are they at that? Nobody, there's a lot of people that go after a lot of markets. They're an expert of none.
Yeah, it's funny. I was listening to a guy in a podcast yesterday. He was listing off what's in his current portfolio, and he's got 5 key things that he's working right now. And they're in 5 completely different markets in 5 different parts of the country, and that frankly scares me half to death.
Rightfully so.
And that's why I came into this. Like, what question am I going to bring to the table? Because I don't want to just sit and listen. But it's like, this is what I'm thinking about. This is what I'm working on as I'm making decisions for my business. What does somebody evaluate when they've been in the business this long? When somebody brings you a deal and you have to look at it, what KPIs are you looking for, and what becomes the no-goes?
That I want to actually turn this into a question. What you just said, I got a good answer to. What you said is one thing that I see a lot of people do, including myself when we started. We looked at all these other submarkets. We looked at all these other cities and states, and we were really looking for deal metrics. What fit an 8% cash on cash? What was a 6 or 7 cap? And we weren't necessarily digging into the micro analysis KPIs of a market. And we bought properties that maybe fit that buy box, but it's sure not what we wanted to buy in the end. Because what we found was just because the numbers looked good when it was sold to us, the market was deteriorating. And we didn't know that because we hadn't been in that market for a long period of time.
Right.
So a lot of people start out like going after a bunch of markets. I would find a market and hone in on it. Get good at that one.
All right, thank you.
Yeah.
Yeah, and I'm not quite as long multifamily experience, but what I've noticed in the last 3 years is people develop teams big enough where they almost have to feed the beast. So they'll go and find a property. Well, it's only 1.8 equity multiple, or they have some excuse as to why that is, but it certainly seems like they're just feeding the volumes of people that they have on their team to keep that team together and keep it running and going. And that's not good for the.
No, not at all.
Well, and that's what I'm learning too, is that I really need to become a microeconomist here. Sorry, economicist. I don't know, whatever we call them, right? And it was like I was listening to a guy talk about the impact of a 2.6% inflation rate that just got announced this morning. And what does that mean? And what does that look like? And what's the impact on what we're doing? And what's going to happen to market confidence? And I'm like, oh my gosh.
Yeah,
I'm
100%.
glad I'm moving slowly.
Hey, slow is fast. I'm also a pilot, and we always talk about, when the engine shuts off, you don't panic. The first thing you do is you look around and you're like, all right, well, the fuel's still on. I've got fuel. No switch or no circuit breakers are flipped off, and then you start going through a checklist and figuring it out. And next thing you know, you're like, all right, everything's good. I've tried the engine. Let's go find a place to land. But slow is fast. And it's the same thing as, we always say, don't fly around fat, dumb, and happy. Be very cognizant of your surroundings. It's very easy when you're flying cross country to get off track. The wind can be pushing you, just same as there's wind in a market, and the wind can kind of push you. And you think you're flying a straight path. And if you're off by an inch and you travel 100 miles, you're off 100 miles. Next question.
Let me just jump in there and piggytail off that question because it adds to what David asked. One thing that I recently learned on a deal, it's a new market for me, not a new market for the team. Okay. This is Macon, Georgia. What I learned is they honed in on that market. They've been looking at that market for probably 2 years. So it wasn't like a property presented itself and they thought, oh, the numbers look good, the underwriting's good, let's buy it. 2 years of looking at that market. And the reason was they were following the infrastructure investment. And so what I've recently learned is if you look at where money is flowing in, so you're talking to the economic development people, you're talking maybe to the mayor of the city, if you can get to them, you're talking to the people who really know where the money's pouring into. So in that example, there's $500 million getting put into just the infrastructure on the interchange from 75. Well, what's that tell you? It tells you they're putting money in there because people are moving there. They need to expand the capacity in that area. So where the infrastructure money flows, you also see companies begin to gravitate to that area. So now you've got existing companies, like one that's been there for 8 years, that's putting $400 million of their own money into creating 600 new jobs in that area, and other new companies that'll move into that area because of the infrastructure that's being developed, right? And then what flows from that is, of course, job creation. You've got higher demand for rentals, and that higher demand for rentals will drive rental rates.
Yeah,
right? So
absolutely.
your rental rates will go up. So it's kind of a waterfall of like starting with the economic development in that area, infrastructure development, and it just flows down from there. And so this is an area that we decided to jump in.
What we call it is we really pay attention to microeconomics. And it's the micro things that you can't see from a 30,000-foot view. You have to really be in the market to really understand it. Anybody during, when I'm answering questions, if you have a question that's top of your mind, please use the raise hand button, and we make sure that we got time for everybody in here. Anybody want to ask another question, go for it. These are great.
Well, if nobody's going to jump in, I've got one.
Go for it.
Yeah, and it sort of is a macro level question. It's dealing with current, economics and markets, and particularly with what fears are being spread and rumors being spread about the stock market and an imminent crash. So what would you say to people in general? I've been in this industry for like 18 months. Okay. So
Yep.
I'm learning. I don't know what to tell potential investors I hear a lot of guys who are saying, oh, I'm just going to wait. We've got an election coming up. Let's see if we can get through a year. Let's wait. And I'm thinking this is the exact time you better start buying, because if you have money just sitting in the stock market and there is a collapse, it might take 8 or 10 years to recover. This is just my thinking. It's going to take a long time to recover in the stock market for that to get built back up. But if you have it in multifamily, you still have tenants in multifamily, and you're right, and most of them are still going to be paying tenants, unless things are economically so bad that everybody's equally crushed, in which case you still have a physical asset as opposed to a piece of paper that was worth potentially something had you cashed out. So
Brad, you hit us.
how do you talk to investors?
Yeah.
I'm in the middle of this right now. So how do I help those investors understand, like, having that money just tied up in stock markets, maybe not a great idea right now?
So please, anyone raise their hand if you have a question, because I'm going to dive into this one really deep, because this is one of my favorite conversations. Here's the biggest thing about stock, bonds, mutual funds, everything else, derivatives, everything people invest in, gold, silver, all the above, Bitcoin, all of it. A lot of people, and it is a true statement, I've read a lot of financial books, and I've done financial analysis for 7+ years, especially when it comes to investing. And when it really comes down to it, everybody's trained that you're not going to lose money. Because if you stay in, you still have the equal amount of shares. So people feel like with stocks and bonds, mutual funds, that if you have 300 shares that are trading at $3,000, you've got that many shares. And the second thing is that you still have 300 shares, even if it goes to $100 a share. That is true. However, when that market comes back up, it may not never get there. The problem is a lot of people refuse to sell before the market goes down. And then when it does go down, they just want to hang on as much as they can. So it's really a roll of dice. It's kind of like going to a casino and hoping the next pull is the one that hits. It's the one where the lights and buzzers go off. Most of the time, you make that next pull and it goes to zero and it's gone. That's my experience. So a lot of people ask me this question. They're like, Eddie, what about the current market? Aren't you afraid in real estate? I'm more afraid about the people that are in the stock market. I'm more afraid about the people that bought properties wrong. And I'm gonna really get into this, because there is more chances that you will lose your money in the stock market and it may recover. But the problem is how long does it take that to recover? The only way that you really lose money in real estate is really comes down to two factors. If number one, you paid too much for the property, and number two, you over leveraged yourself. That's really the only two ways that you can lose money in real estate. And I'm gonna dive into both of those. Number one, you really have to pay attention to how much you paid for the property, the basis. If you paid $100,000 a door, if you buy for $100,000 a door, and this leads into the next very important thing. If you paid $100,000 a door and the market does go down, because markets do ebb and flow. When that happens, if that property goes to $80,000 a door, and as long as you're maintaining occupancy, you're not dinging DCR, debt coverage ratio, you have no fear of losing the property. The only way you lose then is if you over leverage yourself. Now, I know there's a lot of people out there that believe you can buy real estate with 20% down, 25% down. That's not how we do business. And let me tell you why. Because that's how you over leverage yourself. So if you bought a piece of property that you paid 20% down, 20% in equity, 80% on your debt, your debt is a hard number. If you're supposed to pay $200,000 a month, when the property comes down in value, when your tenants quit paying, the bank's not going to allow you to pay less. It's not going to happen. Because of the SEC, and when you do things right as a syndicator or a fund manager, as long as you disclose everything in your PPM, your operating agreement, we can say that we're not going to pay investors returns because we are trying to maintain the value of the property. We're trying to maintain cash flow. So you have the ability to communicate with your investors and not pay that and let the property do what it needs to do to continue to cash flow and continue to pay its payments. In the next year or two, when property values come back up, occupancy comes back up, then you can start paying everyone again. You never lost the property. But if you went in putting 20% down and the property value drops, the market, the demographic starts to drop, your rents were $1,000 a month, they're now $800 a month, and you're down to 80% occupied, and your DCR is below 1.25, you lost the investment and you probably lost everyone's money that invested with you. At that point, that's how you lose money in real estate. That's really the only way that I know how. There's probably hundreds of other ways that you can, but that's the biggest way that I know.
I'm curious what happened. So like in the economic downturn in 2008, 2009, a lot of single family was upside down with that subprime loans and all that stuff.
Yeah.
I was caught up in that with the property I ended up in upside down during that time. I remember it very well. But what happened around multifamily assets during that time?
During that time, the good news is a lot of those people that lost their homes went to being a renter nation. So that's really when you started to see the rents kind of flip, because everybody got a loan pre 2008, everybody. And I'm not going to go into why they got the loan, but everybody got the loan because their qualification standards, and everybody got one. When people started losing their homes and they could not afford, their credit started getting dinged. We weren't as very stringent on credit criteria, mental background, stuff like that. Multifamily did great especially if you had 8 to 10 unit properties. Those were the types of properties that didn't have a ton of overhead that we could allow to people to rent $650, $700 a month. And they did great. Multifamily was a great asset during that time. And we had attractive basis on our interest rates. Interest rates were low because they still didn't go very high during that time. So even if we bought a property, we could still operate. And we had plenty of tenants.
Awesome.
Anyone else?
So Eddie, you mentioned that, going with only 25% down on a property is over leveraged. What would you consider a maximum, LTV, so to speak?
We usually do 35, 40%. Usually we're closer to 40%.
Okay.
At that point, because what you really need to pay attention to is what's your break-even occupancy. Used to break-even occupancy kind of was like 90% was everybody's kind of golden number. Honestly, a lot of subprime markets today and a lot of demographics are usually running around 85 to 88% right now. That would mean that you're in that below break even occupancy. It's kind of a danger zone. So the only way to try to change that out is you've got to raise more money and lower your leverage. So you got to get your debt down so your break even occupancy is not so high.
Fair enough. Thank you.
Following that, is it true then that the more you raise on the equity side at purchase, the quicker you get it to cash flow?
Yes, 100%.
Yeah.
And let's be honest about cash flow. Will a property in the next 4 years ever hit an 8% cash on cash? I'm not sure. I don't think it will.
I don't know.
But cash flow to me, if you have cash flow to 1 or 2%, that's cash flow. If you went in with your basis too high and over leveraged and your loan's $200,000 a month and you're making 160, you're out of the gate in a bad problem. But if you raise 40% and your loan's 120,000 and you're making 160, you got $40,000 a month to distribute. No, I would honestly hold a lot of that back, and I would keep that into a CapEx account or a general partnership account, and I would distribute based on the known facts. Like, do we have a bunch of deferred maintenance? Do we have a lot of things that's going on this property? Do we need to keep marketing dollars? I'm gonna take a sidebar for a minute. I'm gonna talk about marketing on properties. The budgets that we used to have to market our properties, as far as getting new tenants. We might plan to spend $150 to $30 a tenant for marketing. Our marketing dollars now are sometimes upwards of $200 to $300 a click. Click meaning Google AdWords, Facebook advertisements. We're having to pay a ton more for marketing dollars, and that's real money. So real money has to come from somewhere. So what I mean is, if you're making $40,000 a month, you may need to keep some of that money back so you can market the property, because you have to explain this to your investors. Hey, we have made 40,000, but we need to keep 20,000 back for deferred maintenance and marketing dollars, because we're struggling to keep this place full. So we're having to market constantly. We're trading people out.
Eddie, what do you use as a benchmark for reserves in your underwriting?
So as far as CapEx reserves,
Yes.
I usually like to say $300 to $600 a door,
Okay.
or 2 or 3%. That also depends on the city and state, age of property.
Thank you.
See you, David. Thank you. Something else to think about, and we had to learn this lesson as well. When you start underwriting a property, you really have to keep a lot of money. That's why IO is a good thing. Interest only up front is very good for a property, and also having a lot of cash reserves, because you may have to evict a lot of tenants. And also, sometimes if you change a property management company and you have just bought this piece of property, you may have things called legacy tenants. Legacy tenants could possibly be tenants that you do not have keys for and you do not have a signed lease for with your new company. In certain cities and states, it makes it very hard to evict these style of people legally.
So what are your options if you run into that?
It's a game of chess. So to be honest, like Dallas, Texas, if you're going to deliver a notice to vacate, the notice to vacate has to be taped on the back of the door, interior of the door. If you don't have a key to that door, you can't break in the apartment and do that. And you cannot slip it under the door. It has to be formally delivered. So if you don't have a key to that apartment and you don't have a signed lease, so you can't give that person a notice that you're going to enter that apartment in 24 hours, you're kind of stuck. And if they're a professional tenant, meaning they know how to use the system to stay in that apartment, I'm not trying to be negative towards any one person, but we've run into that where we've had people that are very good at using the system and they know how to do it, and they got us. When we bought this piece of property, we switched out a property management company right away. We no longer had leases under the company we ran the property with. It became a problem. And we evicted 60 people. Took a year and a half to do it. These are
Eddie,
great
I'm curious,
questions.
do you have like provision in your lease agreements for a maximum number of people that can live in that apartment?
Also a great question. We often monitor, cars that are parked. So we pay attention to license plates. So any person living in the apartment has to be on the lease. We also need the license plate number to that person, because what we're trying to catch is how many people are living in that apartment. And we found the best way to do that is to pay attention to the license plate number, and then, have your maintenance team that's always out and about on your property, paying attention to visitors, new cars, and people coming in and out of these apartments constantly. How many people live there?
So how do you deal with the boyfriend or girlfriend who's basically living there and is not on the lease?
You pretty much call the tenant down in the leasing office and say, hey, we see there's another person there. They need to be on the lease. That usually,
I'm on there.
yeah, that usually gets them to say, crap, they either are going to have to be on the lease or that person no longer lives there anymore. And again, every city and state, don't take this word for gold. I'm not a lawyer,
Yeah.
not a CPA, but every single city and state has different laws, but that's how we run our properties is we pay attention to it. And, we call the tenant and say, hey, we notice there's other people there. If they're living here for more than, I think, 2 days, we require them to be on the lease.
Hey Eddie, just to follow up on that, how easy or how complicated is it to get the other person added to a lease in a situation like that?
So, they don't necessarily have to meet all the income criteria because it's already signed and has a guarantor, but they do have to pass criminal background. That's another thing. You don't want people hanging out on your property that are, known felonies. I definitely don't want people that are pedophiles or anything like that. Certain people find out about that kind of thing, and that can really make you look very bad in the public eye that you're allowing this to happen, because you have to think about this. If you know that person's living there, you assume that the leasing company and or property ownership is aware of that and letting it happen. And that's not good. So that's why it's very important to mitigate that as soon as you figure it out. So, getting them down there and saying, hey, they need to sign here and they need to have a background check. That's usually the biggest reason we want to do it, because we want a background check. Let's be honest. You don't want, a known abuser, the boyfriend or the girlfriend coming in there and, they come in on the weekend and they stay over the weekend and they punch a bunch of holes in the wall. You got to fix it. You got to everything has to be managed. Anybody else have any questions?
Yeah, I got a question. I got the magic question of the hour, and that is, even though the interest rates have tipped down a little bit, when is the market going to turn and transactions are going to go back up again? Because man, it's so dead.
Boy, Dan, you're gonna make me peer into my golden ball. We bought 2 properties last year in 5 to 8 to 6% interest. I talk to some of these veterans. A lot of people look at me as a veteran because I got 20 years experience, but most of the time I go to a lot of these meetups and these conferences, and the majority of the people in the room are people that only been in this a year or 2 years. So I guess maybe I do look like a veteran. But I actually talked to real veterans that used to buy properties when it was 18% interest, 16% interest, and they laugh at me. They're like, you're worried about 8% or 6% interest? Are you kidding me? They think it's funny. So to be honest, Dan, to answer your question, there's a couple things that have to happen. You can still make sense of a property at 6 to 8% on interest rate. Your biggest issue is there's a lot of people that want a 30% pref to be able to put money into the property, meaning your accredited investors. They want this almost guaranteed, and they want like a 30% IRR. That's not logical anymore. Really, a good syndication today that I would feel good about is probably 14 to 16% IRR on a 3 to 5 year hold. That's logical. The 22s and 24% are probably not true. They would be overinflated. I would say a 1.6 and probably a stretch to a 2x multiple is all you're going to get right now. And that's smart, in my opinion. I hear people still say 2.5% multiple on a 5-year deal. And I'm like, "Nah, you're engineering returns somewhere. I don't believe that, but to each their own. I think also we have a lot of people that have properties right now. And the biggest problem is they've also gave their investors a promise of a 24% IRR and a 2x, a 2.5x multiple. And they still believe they're going to get that. So therefore, that's why everything's slow right now, is because those operators won't sell. They're hanging on. Well, the problem is there's people moving out, the markets are changing, the demographics are coming down. Everybody was achieving 12 and 15% rent bumps where they should have stayed 2.5 to 3%. So now you're seeing this deflation of rents, of rental increases, and then people are moving out because of it. Affordability has changed. So now you're having properties values come down because of NOI, but the sponsor and or operator, they still want their 25% IRR. They still want to make a 2.5x multiple. Well, at some point, the loan's going to mature and they're going to have to sell. Well, the problem is the bank's probably going to be the one that's going to say you're going to sell, because the bank's going to foreclose on it and say, I don't care, but we're selling the property. Well, the ultimate sin to that is that at that point, investors lose their money. Then it makes it that much harder for people like myself and other syndicators in the room to raise money, because now multifamily has this bad name. In my opinion, real estate of any fashion will always be a good investment. Way better than a stock market, way better than stocks and bonds. It does not devalue as fast as stocks and bonds. It doesn't have the volatility. If it's operated correctly, it never loses its basis. If it does, it can be regained over time of ownership. So crystal ball, Dan, I think that there's going to be adjustments. Owners, operators need to take a new, different thought about what this property is worth today to sell it. It has to be attractable to the people that we're going to raise money for. We're going to actually raise money to buy this piece of property, and we're going to pay 6%, 7% interest. So we're going to have to be a little less on the price, and we still have to raise capital. So we have to find a way to give an attractive basis to investors and be able to buy it. That's really the answer. And insurance, I think, is going to balance out a little bit. Interest rates are coming down. It's going to be a good market. Right now, what I hear is it's always equity. Everybody has trouble raising capital right now, which is the one thing that stops us from buying properties.
Yeah, thank you. And I think that the unreasonable sellers think they're just going to hold off in some just because interest rates go down a tad. If they do, and I think the consensus is that it will, that doesn't mean you're going to get all of that back, because for various reasons. But the biggest problem is it's just there's no transactions. It's hard for me to believe that just because sellers are holding on, the cap rates are too low, negative leverage doesn't work. And until there's a balance of sellers accepting a higher cap rate and interest rates maybe coming down a little bit to at least get to neutral leverage,
right?
That's the clog. And
it is.
I've heard that institutional buyers are going to be the first ones through the gate to make some monumental shifts, because everybody knows there's an enormous amount of pin-up equity ready to be released. They're just being, I guess, tight with the money because everybody assumes that this big recession is still on its way and it's slowly unfolding.
Yeah.
But it's a good time to be patient, but it's, when you have, I have probably $750,000 at least of people just waiting to deploy. They've never heard of multifamily before. They're ready to jump in. I haven't had a deal all year, and that's a little bit frustrating, but I understand difficulty in raising large amounts of capital.
You should have called, Dan. I've got deals every day, man.
You beat me to it, Eddie.
Yeah, I was going to say I had to get fast on that trigger. There's going to probably be everybody in the room need money.
We're going to call you now.
Yeah. So, Dan, to really round that question out and give color on it, cap rates also are made up by sales. A cap rate in the market is how properties are traded in and out. They kind of establish that cap rate. And that cap rate is also, rising. What we used to underwrite properties at a 6% stabilized, 6.5% on multifamily value add deal, those are probably 7% plus now, 7.5. So, and now because of that, plus your seller wanting a blue $1 million for it, and then your investors wanting a lot of money for it, you know, really the market, the debt market hasn't tightened up. What the market tightened up on is the buyers not wanting to pay that cap rate, and the seller not wanting to pay that, not wanting to give it up for that price, and then the equity being stringent on they don't want to jump in the market. And then you are 100% right. There is institutions sitting on floodgates of capital, and they're ready. But what they're ready for is when these properties go into a distressed state and get foreclosed on, and then the basis of all the investors and everybody gets wiped out. At that point, the basis of that property is a lot lower. It's easier to deal with a bank than a seller that has a bunch of pride.
Right.
I know a couple of guys right now who are focusing exclusively on rescue capital.
100%.
For
And
these
it's a
guys
good
to get in
idea.
trouble.
It really is. It's a good idea. I mean, for us, you know, I run a construction company. We're vertically integrated. My construction company does all the renovations for our apartment buildings. And because of our vertical integration and how well we asset manage and everything that we do, we are the perfect shop. And we have a $50 million fund that is ready to deploy money as we raise it. You know, we're still raising money every single day to deploy into RV parks, multifamily, distressed, value add, and stabilized, and raw land. We're developing raw land also through my construction company. And with that, a great deal for us would be somebody that has a deal that is completely distressed and they need operational experience. They need somebody that can come in and inject capital, and they need somebody that can do these renovations for a better price, because you're not going to get $300 a month rent bumps. You got to be efficient at $10,500 a door and making $150, $200 rent bumps per month.
Well, if we're at a lull on that topic, there's a question that came in from Samuel. Says, hey, I hope you and everyone are well. Asking a question outside of multifamily as I'm learning about running a successful business. I've recently pivoted and it feels a bit confusing. How do you deal when you completely pivot into a new venture, as I'm sure you have pivoted many times? Thanks.
I have. Samuel, that's a great question. You know, at the end of the day, I think we all are looking to do one thing. We're all chasing that one thing, and that's have enough money to have the freedom to go and do what we want. And there's a lot of people that are really hung in the grind on multifamily right now, and that's the only thing they want to think about when they should pivot. So I'm going to be completely transparent and a little bit vulnerable. We actually decided this week to completely pause renovations on one of our properties. I was doing 30 units a month through my construction company to do these renovations. That means that a lot of the money that we may make through renovations, we're going to have to pause that. And we're going to have to pivot to something else. What are we pivoting to? Raw land development. It just so happened we're signing a contract in the next 45 days to start 258 unit home or 258 homes in North Florida. Perfect timing. So it all works out. But you have to be willing to pivot. You just can't sit and grind on one thing and expect a different outcome. So what you have to do is really lean in on, you know, what's most important, and then what has the probability to make you enough money to be comfortable. And to be honest, my wife and I, we went and bought a motorcycle shop at one point. Didn't really work out for us, but it was a pivot because it was supposed to provide us with $14,000 a month in cash flow, which would have been absolutely fantastic during that time. So, great question. I'm glad we're getting some diversity here. Buying a business can be a great way to make money. If you don't already own a business and you're gaining experience on either buying a company out that's already in existence, there's a lot of ways to learn at the same time buy. Perfect example, fiat conversation, completely phantom conversation here. You found a business that, say, is a laundromat, and it's been owned and operated 30 years. The operator is probably 65, 70 years old. He's ready to give this thing up. He's operated it. He's done. He's ready to go hang out in Hawaii or wherever else he wants to go. You can buy that business with no money down. You can raise capital. You can buy it on seller finance. Most of the time, if it's an older person, I would teach them about owner financing. Because if you give them $500,000 to that business, most likely going to pay 27 to 35% taxes on that deal. He's going to have to pay capital gains tax. You could kick that can down the road for quite a ways and even keep him as a partner. Because what you're still going to need is you don't know how to operate a laundromat. Never done it. But you can say, hey, I will continue to pay you for 1 year and teach me how to run this business. I'll owner finance it. I'll give you 10, 15% profit share, or I'll pay you $3,500 a month for the next 10 years to buy this business. There's 100 ways to structure a contract. There really is. As long as you disclose what you want to do and that person agrees with it, then it's great. See you, Dan. Thank you for coming. So
Thank you. Take care.
You're welcome. Don't be afraid to pivot. Don't be afraid to go after something different, because we're all chasing one thing. We're all chasing, for me, I'm always chasing a way to pay my investors more. I'm always chasing a way to make myself comfortable, my family comfortable, my investors comfortable. And if that means I have to pivot to something else to continue to maintain my investors' returns, then that's what we'll do. And that's what we had to do in real estate. Really, we've had to change and just kind of move in different places and think about multifamily differently to continue to make money in this business and continue to keep the property cash flowing. So you had to pivot. You had to be different. You have to do things outside the comfort zone to continue to make money, continue to operate the property. And to be honest, I love business. I like buying business a lot because you can step into operating cash flow day one. So please let me know if that answered your question. Anybody else? You're welcome, Samuel. Joel, we had talked about a couple things before we joined online, and you had a couple questions you wanted to ask. Go ahead.
So, on the note of capital raising, what was one of the critical things in capital raising that you've seen in today's market that has been more beneficial than, I guess, past methods of capital raising?
You know, I get a lot of questions around marketing and capital raising, and a lot of people that I meet, they, for say, are capital raisers. And they ask me, why are you successful at raising capital? Well, if you look at my Facebook page, if you look at my Instagram, if you look at a lot of things, what I'm talking about here and what I'm talking about when it comes to my Facebook page and my Instagram, this is not a surprise to you. Every conversation we've had here has not been a surprise. You haven't, if you follow me on any of my social media, you're like, I expected him to come out and talk about what he's talking about. You can't have Paula Deen cooking shows on your social media and then suddenly you're raising $2 million for a multifamily apartment building. The algorithm and your audience are completely shocked. They're like, do you need gas money? Do you need groceries? You know, they think you're raising capital, and you have to educate. One of the biggest things is, you know, myself, I constantly turn things down by the way I talk. And by that is I change the terms of what I talk about when it comes to language. You know, real estate acronyms, not everybody understands them, especially when you deal with multiple different ethnics of people, languages that people speak. Sometimes language is different things. Syndication is something totally different for a Latino demographic. Some of the words are different. So you have to speak to where everybody can understand. Like, I've been in many rooms and they're like, I raise money for accredited investors. You know how many people in that room know what an accredited investor is? Not very many. So that's the thing you have to be careful of when you're raising capital, is you have to educate. You have to be, I think before you even raise the dime, you have to be an educator. You have to be somebody that has validated that you're a know, like, and trust person, and that the things that you do match the things that you talk. And then you have to be able to use words that are, in a way, can be translated to other people and they can understand that. And you have to be good at reading people as well. Like when I say, are you an accredited investor? And you look at me like, yeah. But I can also tell in your face, you didn't want to be uncomfortable with asking or saying, I don't know if I'm an accredited investor or not. So You also have to be that person that knows when to explain things the way that person feels like, I guess, yes, I am a accredited investor. But sometimes by coming out and asking you if you're an accredited investor, you may not want to answer that because you don't want people to think, well, I don't want to be what he wants me to be. I'm afraid to answer that in that way. So you have to be able to say, I raise money from everyday individuals. So here's usually my pitch. Eddie, what do you do? Have you ever heard of Edward Jones or Ameriprise? Yeah, I've invested in that. That's where I keep my 401k. Okay. We do the same thing, except we don't invest in stock, bonds, and mutual funds. We invest in real estate. And we allow the everyday person to invest along beside us. Really. And then the questions start to kick off. And then you're comfortable with talking about it. So find something relatable. And then at that point, make sure your social media matches. Don't have a bunch of Paula Deen cooking shows and you're standing in a conference telling people about this $1 million building you're raising money for. And then they go look you up, because people will look you up. Believe me, they will go look you up. And that's why I started doing everything with hashtags and relative things that tie everything together. You can literally go on Google right now and you can type in hashtag Eddie Austin, EDDIE, AUSTIN, and you can see what comes up. All about real estate. It's all relative to exactly what I'm talking about right now.
Notice the common thread tonight, and that is a lot about reputation. Every action you make in this business, your reputation is going to follow you. You fail your investors, you lose everything. You have to start over, and it's really hard to remove that tarnished image.
You got one name, one company. You can start many more companies, but once you diminish your name, it's we got any more questions in the comments?
Yes, there's one. What is the one question? This is from Jenny. She said, what is one question that you wish we couldn't have asked, or we could have asked someone when we first got started? And how would you answer that now?
Man, to be completely honest, somebody that could have answered my questions. When we first started our first fund, everything we asked cost us money. It really did. And I mean, there was times that when all of our lawyers sat in the same room, I was shaking like a leaf because it was $1,200 an hour. But we learned from some of the best mentors there was. They were real security attorneys. They were real attorneys that dealt with building funds and raising capital. And these guys had done $100 million deals. We were learning from the best, but I had to pay the price. So what I wish I could have had was a mentor that didn't cost me $1,200 an hour, and somebody that could have helped me. And just some of my questions were simple, like, can I raise money from accredited and non-accredited? I can tell you that now. At the time, I didn't. And the difference now is, yes, you can. It's called 506B or it's a 506C, and there's caveats to both. So, I've seen that you put in the comments my hashtag there for hashtag Eddie Austin BEX, and you find all my social medias on there, and you can see, hey, this guy is a real estate mentor. He's been in the business. He does this every day. So when I go out and raise capital, people are not shocked by that. Another thing that I wanted to get to is I don't raise money so much, I attract money. And now that kind of sounds like an egotistic statement, but it's because of all the things you do, people start to recognize you as being that person in the space that you can come and ask. And then my wife can tell you, and my daughter, we walked into a bowling alley. In the bowling alley, the owner of the bowling alley happened to follow me on Facebook. I didn't know this. He walked up to me and he said, Eddie, I follow you on social media. I love everything you post. I'm getting ready to sell my business, my bowling alley here, and I'm looking for an alternative investment. I want to be a passive investor. And by the way, I didn't know what passive investing meant until I watched some of your videos. That's the power of it. I didn't walk in that bowling alley and say, would you invest $500,000 in my fund? Also coming into rooms and telling people what you do. I've been standing in a suit in Salt Lake City before, and somebody in a hotel lobby says, what do you do? I can't get a room here, I guess, because there's a bunch of people in suits. I gave them my pitch. He had $300,000 in his IRA, self-directed IRA. He became an investor. He asked me the question and I just answered. I'm not bragging. I'm not. Don't take it the wrong way. I'm not. It's just I learned how hard it was to try to do things the other way. And I've learned what worked for me. Doesn't mean it'll work for you, but it worked for me. He did get a room. He absolutely, not with me, but he did find a room. Yeah. But, just things like that is, being, and that's another thing, being in the room. Sometimes you have to be in the room. And that's one of the reasons I wanted to make this space right here, this kind of community. We're going to continue to do this. So we got about a few minutes left. We can go over on time. That's fine with me. But I would like your feedback in the comments if you think we should continue to do this, because I want to continue to do this. Maybe on a weekly basis, maybe even 2 times a week. And my goal is I want to build a community that you can get questions answered all the time. And there's resources there. There's deals there. You can always ask questions. And then we also have this live open discussion where you're not talking to somebody behind the scenes. You're talking to somebody on the screen 2 times a week. I love that, Cindy. So that's another good question. Heather asked a good question as well when we first started thinking about this. Heather and Joel and Jennifer are all my partners in Extraordinary Capital. We do this together. We started asking, what's the frequency that we want to do this and what is the times? Because I know there was over 10 registrations before we opened this up. And I don't know that there's 10 people on here. I'm not counting, but I see names that registered that are not on here. So I think sometimes times don't work out for everybody. So we're thinking about doing this at 2 different times. Maybe one time is in the middle of the day, maybe like 10 o'clock in the morning or 1 o'clock during the day, and then maybe 5 or 6 in the afternoon. So also leave in the comments what times you think, and we can kind of take an open poll here, what's best for everybody. I have learned not to do this on Friday afternoon because I did that for about 6 weeks and it didn't work. My participants went down drastically on a Friday afternoon, 10 a.m. Okay. So I'm thinking maybe.
I was saying 10 a.m. is too early for people on the West Coast.
Okay, perfect.
So yeah, I think around noon, 12, 1 o'clock, if you're doing afternoons, gives people on the West Coast a chance to be in during the morning. EST or up to early afternoon.
Okay, great. I think you're right. Let's take a note of that. I think maybe Tuesday and a Thursday. You're welcome, Samuel. I'm thinking Tuesday and Thursday, we probably want to do this, or maybe it's Wednesday and Thursday. I know Monday and Tuesday is usually a rip for me. I got all my meetings on properties and stuff on Tuesdays. I got a lot of partnership meetings on Mondays. So it's hard, but I can also make time for this as well because I love it. So I'm thinking maybe Wednesday and Thursday, if that's good for you guys. Good. Thanks, John. Well, this has been great. Well, I want to do something cool right before we end this here. I think how we're going to end this call is I want people to share the greatest quote that they've heard from one of their mentors. So, for instance, it can be, for me, one of my favorites for this one's very simple. Henry Ford. If you think you can or you think you can't, you're right. You're 100% right. So to leave this meeting, let's start by, if anybody has one without being uncomfortable, I understand the introverts in the room. You can put it in the comments or you can just say it out loud. What's the best quote that you use constantly? What's one that you constantly remind yourself of?
I'll go first. I think Benjamin Franklin is at least accredited with this quote. I don't know if he actually was the first to say it or not, but it is, well done is better than well said.
I love that. I love that.
And I'm not sure who exactly has the original credit of this quote, but one of mine is hard work beats talent when talent doesn't work hard. You don't have to be amazing at everything you do, but if you work hard at it, you can do it well and you will succeed.
Yep.
Can you please repeat that?
Yeah, hard work beats talent when talent doesn't work hard.
Go for it, John.
Okay, I want to make sure I get this one right. So I hear this one a lot, which is your network is your net worth, or is it your net worth is your network? I don't know, backwards, whichever way. That one always stands out. So
yeah, your net worth is in your network. And it really comes down to it. You know, I had somebody the other day, he's like, man, I need to raise $100,000. I said, let me see your cell phone. I said, or open your cell phone. How many contacts you got? And I think he had like 500 or 600 contacts. I said, you need to raise $10 a piece, buddy. You know, there's nothing to it. Made $100 a piece. How much money can you raise like that? You know, that's the thing is, you know, everybody forgets the amount of people that's in their corner. Anybody else have a good one? Doesn't even have to be good. All of them's good, in my opinion. No pressure, no diamonds. Love that one too. Everybody wants to be a diamond, but nobody wants to succumb to pressure. All right, everyone. I think we're going to go ahead and cut this one off. It's been a great time with you all. Spending it here this afternoon was absolutely amazing. And I'm glad that we got to do this. I'm looking forward to the next one. So we've got your emails from where you signed up. You also follow me on social media. Follow that hashtag. Follow me on any platform and stay tuned. We're going to be doing a lot more of these. And we're also working on building a community where everyone can collaborate and get resources they need. And I want to do it very inexpensive. I want it to be at a level where everybody can comfortably sign up. So we're going to continue to do this as a free Q&A. And then we're also going to build a community for people that want more resources. So thank you all. It's been a pleasure. You all have a great day.
Thank you, Eddie.
Thanks.
Thanks.